Hey guys, so I'm sure that many of you are familiar with the standard pivot points, but let me ask you, how many of you take your trading decisions based on the daily pivot range? The daily pivot range is one of the most powerful pivot indicators and is very important because it can tell you a lot about the potential movement of the upcoming day and can offer a certain bias about the current day's price action. What if I told you that knowing this location of this price range will allow you to know the pulse of the market and will also provide you with a significant trading edge? So in this video, we'll discuss about this new concept regarding the pivot points, the daily pivot range. You'll discover how to interpret this range, and you'll also learn how to trade based on this important area. Before you continue, if you are new to this channel and you find value or learn something new, please consider subscribing and leave us a like to show your support. So, the daily pivot range concept was introduced by Mark Fisher in his book The Logical Trader. The pivot range aims to identify areas in which the buyers are likely to support the market or sellers should dominate the resistance. The pivot range is easily calculated using the high, low, and close of a trading period. First, we add the high, low, and close of the previous trading day and divide this number by 3. Let's say that a stock had a high of 100, a low of 90, and closed at 98. Those three numbers added together and divided by 3 would be 96. This is the daily pivot number. Now you add the high and the low and divide the amount by 2. In this example, adding the high of 100 and the low of 90, then dividing by 2 would give you 95. Then we calculate the difference between the daily pivot number that we previously calculated, 96, and the number we calculated before, 95. The result, 1 point, is the daily pivot differential. The daily pivot range is equal to the pivot number plus and minus the pivot differential. In this case, the pivot range would be 96 plus 1 and 96 minus 1. Now that we've calculated the daily pivot range, what does it tell us? First, the underlying tone or the sentiment of the market is revealed when we look at the close of the previous trading day compared with today's pivot range. If the previous close was above today's daily pivot range, that would be considered bullish for today's trade. If it closed below the daily pivot range, it would be considered bearish. For example, if the market closed yesterday at 69.4 and the pivot range was lower at 68.4 to 69, it would set a bullish tone. Conversely, if the market had closed yesterday at 69.7 and the pivot range was at 69.8 to 70, it would indicate a bearish tone. The daily pivot range will help you to see where something has to happen. If the market is below the pivot range and makes a move upward, it will meet resistance at that level. If the market does manage to break through the pivot range, it would have enough force behind it to make a significant upward move. Conversely, if the market is above the pivot range and makes a downward move, it would find support at that level. If the market does breach that support, it should have enough force behind it to make a significant downward move. The next step is to factor the daily pivot range into your trading strategy for the current day. Depending upon where the market settled the previous day, the daily pivot range would either be support below the close or resistance above the close. If the market settled within the daily pivot range, it would be neutral. Now, based upon what the market does today, the current day, the pivot range would either validate or dismiss the previous day price action. For example, let's say that on a day, the market rallied intraday and settled strongly above the daily pivot range. That obviously sets a bullish tone for the next day. For the bullish sentiment to be validated, the market would have to find support at the daily pivot range and not trade below it, like in this case. But what if the opposite happened? and the market broke through the daily pivot range and traded lower, then the previous day bullish indication would be invalid. If you have identified the daily pivot range as support and saw the market going easily through it, this would be a good time to short the market. Why? Because the market broke through the daily pivot range so easily and is likely to go much lower. Let's take a look at some specific strategies using only the pivot range. As you can see on this chart, the ExxonMobil stock has a daily pivot range of 81.2 to 81.4 and closed at 82.9, setting a bullish tone for the next day. The next day, the stock opens at 83.1. The pivot range at 82.4 to 82.7 represents support. The stock trades lower, approaching 82.6, but does not go below and find support. At that point, the price bounces and trades immediately higher to 82.9. What does that tell you? In this instance, the market has snapped back near the pivot range area and it reversed quickly. In this instance, you would go long after the market bounces off the pivot range. Why? Because the pivot range identified support. The market traded to that support level, but it couldn't go further. As it rejected that area, the likelihood was for an upward move. As in every trade, the question you must always ask yourself is, where do I get out if I'm wrong? In this example, with a long position taken above the pivot range, your stop would be on the other side of the pivot range. Now let's change the scenario. In this chart, you can see that the ExxonMobil stock has a daily pivot range of 81.6 to 81.75 and it closed at 82. It opens the next day at 82.7 and it traded lower. In this example, as the market approached the pivot range, the selling intensity increased and the stock traded lower, and the market sliced easily through the pivot range and traded down to 81.1. At this point, you are watching to see if the stock does indeed trade below the pivot range. It found resistance at the pivot range area at which you would initiate a short position. Once again, where is your stop? At the top of the pivot range above 81.9. So, as the market broke through the daily pivot range and traded lower, then the previous day bullish indication would be invalid. That's why it's always good to wait for the price to confirm or invalidate our bias for the day. Let's take another example. What works when the market is above the pivot range is also applicable when it's below the pivot range. For example, in this chart, this stock had a pivot range of 82 to 82.6 and closed the previous day at 81.6. The market opened higher and stalled around the pivot range and then slowly consolidated around that area. At this point, the market reverses and came back to retest the range at 82 level. What would you do? Of course, this is an opportunity to short the market. Why? The market touched the edge of the pivot range, but it couldn't penetrate the resistance zone. The likelihood was for a downward move. Your risk to the upside would be the other side of the pivot range. Here's another scenario. You can see the pivot range is at 82 to 82.4 with a close at 81.75. This time, the market opens at 81.6 and trades steadily higher to 82.2, right in the middle of the pivot range. What would you do then? You would wait. This is a neutral area, and until the market gets through one side or the other, you don't take any trades. So you don't take any positions while the market is inside the pivot range. Under another scenario, this stock has a pivot range at 68.2 to 68.4 and the outlook for today was bearish as the price closed lower than the previous day. but this time the market traded steadily higher from the opening and, as you can see, was able to slice through this resistance zone easily. What would you do now? The answer is obvious. With the pivot range acting as resistance broken to the upside, your strategy would be to go long. Your stop is of course the bottom of the pivot range below 68.2. By now I hope you realize the power of this technique. Using the daily pivot range is one of the most powerful ways to establish the potential movement of the upcoming day, which can offer at the same time a certain bias about the intraday price action. So, if you learned something new and found value, please consider subscribing to our channel, share and like this video, as it would help us a lot in the future. Until next time.